Hello everyone. Let's start our discussion today by understanding a very important concept in the Indian stock market, the Nifty 50. Imagine you want to know how the Indian economy is doing in a single glance. The Nifty 50 is like a report card for the market. It is an index, which is simply a collection of the 50 largest and most actively traded stocks listed on the National Stock Exchange, or NSE. These companies come from various important sectors like banking, information technology, energy, and consumer goods. So when you look at the Nifty 50, you are essentially getting a snapshot of the health of India's biggest businesses. It's a powerful tool that tells a big story with just one number. So why should you, as an investor, care so much about this index? Well, the Nifty 50 is what we call a benchmark. It sets the standard. When you invest in stocks or mutual funds, you often want to know if your investments are performing well. You can compare your portfolio's returns against the Nifty 50's performance. If your investments are growing faster than the Nifty 50, you are doing a fantastic job. It helps you gauge your success. Furthermore, because it represents a diverse range of top companies, its movement gives a reliable indication of the overall market sentiment, whether investors are feeling optimistic, which we call a bull market, or pessimistic, which is a bear market. The Nifty 50 is not just for seasoned investors, it's a fundamental concept for anyone beginning their investment journey. Think of it as the first chapter in the book of stock market investing. By tracking its movements, you begin to understand the rhythm of the market. You learn about concepts like volatility, support, and resistance levels. Many financial products, such as index funds and exchange-traded funds, or ETFs, are designed to directly mimic the performance of the Nifty 50. This allows new investors to easily invest in the broader market without having to pick individual stocks, which can be a much riskier and more complex task for a beginner. For all these reasons, the Nifty 50 is deeply woven into the fabric of India's financial landscape. It is constantly discussed on financial news channels, written about in newspapers, and analyzed by experts across the country. Its movements can influence economic policies and corporate decisions. When the Nifty 50 goes up, it often brings a sense of confidence and prosperity, signaling economic growth. Conversely, a significant fall can create concern. Therefore, keeping an eye on the Nifty 50 is not just about tracking stocks, it's about understanding the pulse of the entire Indian economy, a crucial skill for any aspiring investor. Now that we have a solid understanding of what the Nifty 50 is, let's look at how it has been behaving recently. Over the last few weeks, the market has been on quite a rollercoaster ride, showing significant volatility. Investors have witnessed both sharp rises and sudden falls. Just last month, in May 2025, the index touched a remarkable all-time high of 23,500, driven by positive global cues and strong domestic earnings reports from several blue-chip companies. This peak created a lot of excitement and optimism among traders, with many believing the bull run would continue its strong momentum into the new financial quarter. However, the market is never a one-way street. Following that impressive high, we saw a period of correction. The Nifty 50 faced some headwinds and retreated from its peak. In the first week of June, it tested a low of around 22,800. This dip was largely a result of profit booking, where investors who had bought at lower levels decided to sell their shares and lock in their gains. There were also whispers of potential global economic slowdowns that made some investors a bit nervous. This tug-of-war between the bulls, who want the market to go up, and the bears, who want it to go down, is what has defined the market's character recently. This volatility, while sometimes unsettling, is a normal part of how the stock market functions. It reflects the constant flow of new information and the changing perceptions of investors. The range between the recent high of 23,500 and the low of 22,800 has now become a critical zone for analysts. These levels act as psychological barriers. If the Nifty 50 manages to break convincingly above 23,500, it could signal the start of a new upward rally. On the other hand, if it falls below 22,800, it might indicate that a further downturn is possible. Watching these levels is key to understanding the market's next potential move. As we stand today, the Nifty 50 closed the previous week on a cautiously optimistic note, settling around the 23,000. The management of the same businesses from the dip is still trading below its weekly low. This suggests that the market is currently in a state of consolidation. It is likely the market is taking a breath, deciding which direction to take next. Investors are carefully watching for the next big trend, whether it's positive or negative, that will push the index out of this current range and set the tone for the coming weeks. So, what are the big factors influencing the market right now? One of the most significant pieces of news has been the recent announcement from the Reserve Bank of India, or RBI. In its latest monetary policy meeting, the RBI decided to keep the repo rate unchanged. This was largely expected by the market. An unchanged interest rate provides a sense of stability, as it means borrowing costs for companies and consumers will not increase for now. This is generally seen as a positive for the stock market because it supports corporate earnings and encourages spending, which helps the economy to grow and flourish. Another major event on everyone's radar is the upcoming announcement of the national budget. There is a lot of anticipation around potential policy changes, especially regarding infrastructure spending and tax reforms. Any positive announcements in the budget could act as a powerful catalyst for the market, potentially pushing the Nifty 50 towards new highs. Conversely, any unexpected negative policies could dampen investor sentiment. Because of this, many investors are adopting a wait-and-watch approach, preferring to see the final details of the budget before making any major investment decisions. This uncertainty is contributing to the current consolidation phase we are seeing. Given these factors, what are the experts predicting for tomorrow, the 16th of June, 2025? The consensus among most market analysts is one of cautious optimism. Technical analysts who study charts and patterns point out that the Nifty 50 has found strong support near the 23,000 level. This means that whenever the index has dropped to this point, buyers have stepped in, preventing it from falling further. For tomorrow, the immediate resistance level to watch is around 23,250. If the Nifty 50 can successfully cross and sustain above this level, it could signal renewed bullish momentum for the day. However, experts also advise traders to remain vigilant. The global markets, particularly the US markets, will play a crucial role. Any significant overnight movement in the American indices could influence the opening of the Indian market tomorrow. The immediate support level is pegged at 23,050. If the Nifty 50 breaks below this level, we could see some selling pressure that might push it back towards the 22,900 mark. Therefore, the general advice is to expect a range-bound session initially, with the market's direction for the day likely being decided by whether it breaks the key resistance or support levels mentioned. To summarize our discussion, the Nifty 50 is a vital indicator of the Indian stock market's health, representing the country's top 50 companies. Its performance serves as a benchmark for all investors. Recently, the market has been volatile, swinging between a new high of 23,500 and a low of 22,800. This movement has been influenced by key events such as the RBI's decision to hold interest rates steady, which has provided some stability, and the anticipation surrounding the upcoming national budget, which is creating a sense of caution among market participants. These are the main points to remember from our analysis today. Looking ahead to tomorrow, the 16th of June, experts anticipate a market that is likely to trade within a specific range. The key levels to watch are the resistance at 23,250 and the support at 23,050. A breakout on either side of this range will likely determine the market's trend for the day. While the underlying sentiment remains cautiously positive due to stable domestic economic fundamentals, global market trends will also have a significant impact on trading. Therefore, it is important to be aware of these levels and the broader news flow when making any trading decisions for tomorrow's session. For all the new investors joining us, here is a simple and very important tip: focus on learning. The stock market can seem overwhelming at first, with its jargon and fast-paced movements. Instead of trying to make quick profits by timing the market, which is extremely difficult even for experts, focus your energy on understanding the basics. Read good books on investing, follow reliable financial news sources, and learn about the companies you are interested in. Your goal in the beginning should not be to earn returns, but to learn as much as you can. Knowledge is your greatest asset in the world of investing. Remember, successful investing is not about making risky bets. It is a marathon, not a sprint. It is about making informed decisions and being patient. By continuously tracking the Nifty50 and understanding the factors that influence it, you are already taking a significant step towards becoming a more confident and knowledgeable investor. Keep learning, stay disciplined, and invest wisely. This approach will serve you well on your journey towards building long-term wealth. Happy investing, and I'll see you again with another market update soon.